95% probability. And by the way, what that means is that the other 5%, it could be way more than that, or it could be way less than that. Okay, and that's happened in the past. But given, and so how do we do this? How do we do this calculation? Okay, we do the calculation based on what has happened in fact in the world, in the market, in the stock market, and with the securities that they may have or that they may want. Okay, and it looks at each security and the characteristics of each security. Now, what drives the price of a security? It's basically somebody's perception of its value in the moment, but also in the future.
Hey folks, would you agree with me if I said, or if I asked you, is education important? How about if I asked you, is money, wealth management, and knowing what to do to secure your future, is that important? Well, both are very important, and that is what we're going to learn and talk about today, is wealth management. And my guest is Andrew Parrillo, and Andrew can be found at victoryroad.com. So we're going to talk all about money, about wealth management, what it takes to set the mind straight, or just to set the mind. So if you're ready, let's get to it. But of course, before we jump into that, I'd like to remind you that if you're a pet owner, please be responsible, have your pets spayed or neutered, and please remember to like, share, and subscribe to this channel. Now, let's do it.
Welcome to Amazing People, Amazing Things with your host, Chuck Tuck.
The most important thing about investing is the most valuable asset is time. Okay? It's time in the market, and if you have time, you can compound your wealth. If you're in a hurry, you just don't have as much time, and so time is super valuable. So, I guess for starters, I would say the biggest risk in investing is not to begin, is not to invest. That's the biggest risk, and many people are concerned about the risk of losing money, and that's a valid concern for sure. And it can happen, and it will happen in the market, in the stock market for sure. But over time, it's always recovered. Now, when I say always, that's over 100 years. So maybe it'll change, but in 100 years, it hasn't changed. And I can go on more about that too to give some more context to that. But
yeah, if you wouldn't mind, because. And forgive me, we'll probably jump around a little bit about this. I'm going to be that guy that's just going to ask from the seat of my pants about this wealth management and wealth building. We'll go into your book. But, I often hear people that are investment advisors, or even people who are not, but who are people who just invest. They say, oh, don't worry about it. You'll make it up in time, long term. But then you ask yourself, well, what is long term? Is that 5 years? Is that 10 years? Or are you talking 30 years? Because I'm 60 years old and I can't wait till I'm 90. So what is this? What is that term of long term?
well, I would say, Chuck, it's probably more than 5 years. Okay, it's probably around 10. Okay, but I would say that I don't think there have been any 20-year periods in the last 100 years where the stock market has not been profitable. Okay. There have been 10-year periods when it has not been profitable. Okay, and for example, the 10 years ended in June of 2009, which was actually 9 years after the dot-com crash. But the stock market lost 3% a year for those 10 years, and people might forget that. But the people who stayed invested during that long period of decline, and there was the dot-com crash, and then there was the great financial crisis that started in October of 2007 and went until March of 2009. So there were two 50% crashes in the stock market during that 9-year period. Okay, but it came back, and it didn't just come back a little bit, it came back a lot. Okay, so the 10-year return, the 20-year return through September on the Standard & Poor's 500 was 634%. The 20-year return. Wow. 634. Now the 10-year return was 236%. But if you didn't have the fortitude, the emotional resilience to stay invested after that long decline, after the great financial crisis, you never got on the train, you never got to the destination, you never made any money. And the other thing that happened then is, as you might remember, this interest rates were lowered by the Federal Reserve System significantly after the Great Financial Crisis. So the interest people were getting on savings accounts was very low. And of course, mortgage rates got to be very low too. Okay, we remember that. So that was good. But the interest rates you were earning on your money also were low. But what happened during that that period after the Great Financial Crisis in 2009, and it seems like forever ago, 2009, but it was not that long. All right, it was 15 years ago, but it was an important point in time. And what happened was you didn't make any money on savings accounts or in bond investing, but you made a lot of money in stocks. And and there was people. This gets a little bit wonky, but the professionals said that was a period of financial repression. The Federal Reserve System was forcing people to take risk because they were not making any money with their savings accounts or with short-term money market funds. So they were kind of forced to assume risk. And guess what? It paid off. The risk definitely paid off. And will it do that again? Over time, I think it will. It has. But it does take emotional resilience. And I guess the thing I would say about investing is, and there's a picture in back of me of Muhammad Ali with his hand out. Right? But I think boxers are pretty smart guys, and he was amazingly smart. But the other smart boxer was Mike Tyson. And Mike Tyson said, everybody's got a plan till they get punched in the mouth. That's when they step in the boxing ring. Right? And they get punched in the mouth, and then their plan for the match just goes out the window, and they panic and they lose. Okay, and so it's important to keep that in mind. If you have a plan, you have to execute your plan because you are going to get tested. You're going to get punched in the mouth. That will happen, and there's no way around that. So if you're talking to somebody who's, oh no, we can avoid that, we can sidestep those risks. It'd be nice to think you can, but it's really hard to do that. And people want naturally to avoid risk. And the work that I've done is based on behavioral finance research that was done largely by a Nobel Prize winning psychologist whose name is Daniel Kahneman, and he wrote a book, Thinking Fast and Slow, which I highly recommend to people. And it's basically, it found that people are 2.5 times more concerned about losing money than making money. And I think we can all relate to that because, it's like, hey, wait a minute, dude, I don't want to put my money in the stock market. I could lose 25% in a week. Now, we don't remember now maybe, but it was only 4.5 years ago that we had the COVID crisis. And in February of 2020, the stock market began declining when COVID really hit hard. And it went down 35% in 30 days. And then it recovered. And it didn't recover slowly, it recovered quickly, as it happens. But the reality is that you will be tested, and the people who lost were the people who panicked and sold because they thought they were reducing their risk after a decline. But what they were really doing is they were increasing the risk that they would not achieve their objectives, which probably were based on a longer horizon than just a month. Okay? Yeah. But to give that 1 month decline was pretty scary, and who knew what was going to happen to the world with this pandemic? Nobody knew. But we know what happened now, and it recovered, and people get back to, I will say normal, I hope normal. I'm not sure anything's ever normal. Well, the thing that's interesting about this whole subject is in life, in the financial markets, in nature, things have a way of returning to their average tendency, and they revert to the mean. I mean, the academicians or they call it reverting to the mean being the average. And in the stock market, the average is around 10% over time. Okay, but much of the time it's going to be fluctuating, either way above or way below that, and so it's never going to be exactly at 10%, but it'll be going up through it on the upside, through it on the downside, but over time it's been about 10%. And let me this gives me the opportunity to say this, and this is really important. why would anybody assume risk with their money? Well, we assume risk with the money because we have inflation. And guess what? Inflation is pernicious. It destroys the value of money. And in the last 10 years, the value of the dollar cost $1.32 to buy something that cost $1 10 years ago. There's been 25% inflation in the last 10 years. Now, it seems like maybe more than that to some folks, and some items have gone up, but those are the government figures. Okay, and those are the government statistic. In the last 20 years, the dollar's down 40% in value. So the reason people invest in the stock market is to preserve the value, the purchasing power of their assets in the future. So we're kind of victims of inflation in the moment. We can't do much about what we have to pay for stuff today, tomorrow, next week. We can change our buying habits, and probably a lot of people have, okay, given the inflation we've had in the last few years, post-COVID, which was supply disruptions, and we know that. But the point is that we don't have to be victims of inflation in the long term. We can be beneficiaries of, in other words, instead of being sort of at the mercy of the big corporations and paying whatever prices they put on goods and services that we consume, we can have them work for us. If we invest in them, then they're working for us. So let the corporations help us out and help us keep the value of our money intact over time, because they're working for us. And that's kind of an interesting concept that people don't think about that when they buy stocks. They think, oh my God, I'm gonna lose money, or maybe I can make a lot of money, or if I'm in Robinhood, maybe I could make a lot of money real fast. And maybe they will, maybe they won't, but that's speculation. Okay, we're talking about investing here, not speculating. And but think about it that if I buy into, say, the Standard & Poor's 500, which is a popular index of common stocks, okay, and you can do that for almost no minimum amounts with the bigger firms, and it doesn't cost very much to do that. The expenses are very, very low. They're like a couple hundredths of a percent. And so you can do that. And think about it this way, that you're buying a piece of corporate America. You're buying a piece of that machine that creates profits over time, that for 100 years has averaged 10% a year. So that's what you're buying. And if you look at it that way, it makes it a little bit easier to accept the risk. It's never easy to accept risk, but it's easier perhaps. And knowing that, if you just hold your dollar bills in a safe, they're not going to be worth much, even if we have 2% inflation, right? Think about 2% inflation for 10 years, it's going to be 20%, right? Or thereabouts. And 10 years goes by pretty fast. Now, I know young folks don't think 10 years is going to go by fast, but trust me, it will. Right? Would you agree?
Yeah. Oh, absolutely, because this time has flown for me, I'll tell you that. I just want to jump in because during what you were saying, there are two things that really stand out to me, and that is fortitude and resilience. And a lot of times I think with investment, it comes down to a mental resilience, being able to change and accept, kind of like what you're saying, that goal. Don't cut your goal short because you're afraid that you're going to lose. And then you do this emotional buy, sell, trade type of thing. Is that kind of right? I mean,
that's absolutely 100%. That's 90%. What did Yogi say? It's 90% of the game is half mental. But it's like that's 90% of the game. It's just being resolute and knowing you will be tested. Okay, you will be tested, and the way you're going to win is to pass that test. And the test is that stay invested, and if possible, keep investing through those difficult periods if you can. If you're still investing now, I didn't say this, but the best way to do investing to start, and this should be for everybody. And you could start with very little money. $20 a month, $50, $100 a month. It doesn't take a lot to start. And if you put a little bit of every month, and that's called dollar cost averaging. So you're buying when the market's high, you're buying when the market's low, it comes back. But over time, you're going to be owning more and more shares of stock, and which over time should appreciate. It has historically, it should appreciate. And what I would encourage listeners to do is to go and find a calculator, a compound interest calculator on search, and you can do it with all the search engines, will bring you to a compound interest calculator, and just put in an amount, put in $100 and say you're going to earn, not a lot, say you're going to earn 5% a year. And you can put whatever percent you want, but it's not unreasonable to think you could make 6 or 7 or more. So put in 6% a year, or 7% a year doubles money in 10 years. So if you put in 7% and you put in, let's say, $100 a month, and so you could do these calculators to show that, then what's it going to be worth in 5 years, 10 years, 20 years? And I think most of your listeners will be pretty amazed at the numbers. And the thing that's cool about the world today, this was not true 25, 30, 40 years ago, but it's true today. Everybody has access to prudent investment vehicles, to ETFs, exchange traded funds, through the big companies, as I said earlier, for low minimums and for low fees. And they also are available to give you some guidance on what to do. Oh, how do I do this? How do I get my money from the bank to the to your firm? How do I get invested in the stock market? And they can help you with that. But it doesn't cost anything. The one thing you can control, and this is the subject of my book, one of the main subjects, when you can't control the outcome. Okay, we've just gone through 10 years of really good markets, it's not always going to be that way, but you can control your expenses. Okay, and they add up. And right, so let me, and I could put some numbers on that, but again, if they do a compound interest calculation, they'll see that if they're paying somebody 1% to help them invest their money, and many of these wealth advisors charge 1% or more, and some say they charge a lot less, and you just have to be sure that they actually are charging a lot less. And we can go into that because it's not the most transparent industry. Okay, some things are not as clear as you might like them to be, and so you have to ask a lot of questions. And again, my website, we offer the questions to ask. They're common sense questions. And what are the questions? The questions are, I was an institutional investor for decades, for over 4 decades, and I invested money with my own firm that I owned for endowment funds. Okay, and I helped them invest. And so I had to follow a very structured, disciplined approach to strategy. How are we going to allocate assets among different categories of stocks, bonds, real estate, etc.? And then how are we going to actually implement those strategies? Which managers or which funds are we going to use? And all of that required a lot of research. But it was all based upon asking pretty simple due diligence questions. That's what the industry terms these questions as you're doing diligence, due diligence questions. And so those questions, those due diligence questions, I have a list of them on my site that's available to anybody that wants to, get it. And yes, you have to put your email address in. Yes, you have to put your phone number in there. But I'm not going to be bothering you. You do whatever you want, but you get those questions. And and there's just common sense questions. How do you add value, Ms. Advisor or Mr. Advisor? How do you do that? What do you charge? How much will I make after I pay your fee compared to what I could do if I just invested in an index fund? Okay, which is, people call it passive investing. That's what it's called. I don't necessarily refer to it that way, but because you can't make a decision about taking risk passively, you're making an active decision, right? You're making a decision to assume risk, and you have to know what that means. So what are the likely, outcomes? What should I expect with this portfolio? Now, I get into that quite specifically with clients, okay? And that's the most important thing you can do, is to figure out what is your preference for return given the risk that you feel comfortable with, okay? And once again, on my website, there's a complimentary risk questionnaire, and it asks a series of questions. And the questions go with something like, okay, are you investing for retirement or college savings, or what is your purpose for investing? How much do you have? And you can put whatever number you want in there. It's confidential. But then it asks a series of questions. Well, okay, would you be comfortable with an asset that might be up 20% over the next 6 months, but it could be down, 12%? I don't know, I don't like the down 12, and the up 20 sounds good, but why don't we make that a little less narrower range? Okay, so then it'll come back and say, well, how about up, up 15 and down like 8? Well, that sounds a little better, but it's still a little more risk than I want to take, so it's a series of iterative questions. That's called prospect theory. It's based on prospect theory. So the prospect is, what could I, what would I like to make? What are the prospects for my returns, and what are the prospects for the risk that I'm assuming for those returns? And so you come up, and after you finish, it takes 5 minutes to do the questionnaire. It's not long. It's not very involved. You can just do it off the cuff. It's not difficult. And what happens is then it comes up with a risk score. Okay, so it's unlike a lot of people who say, well, I'm an aggressive investor, or I'm a conservative investor, or I want to preserve capital, or I want income. But no, this doesn't do that. This comes up with a risk score. Now, what does that mean? Well, it means that the spectrum of scores goes from 0 to 99. And 99 would be like if you owned NVIDIA, or some very, high beta, high risk stock, but high return too, as it turns out. It could be high risk, but it is high risk, but it's also high return, but has been. But in the Standard & Poor's 500 is a 75 risk. Okay, and a savings account would be like basically no risk, almost zero risk, like 5 risk or something. And so you come up with a risk score. And what's interesting about this is recently I had somebody respond to the questionnaire, and they wanted to go through their portfolio, and so their risk score turns out to have been 60. And I thought, oh, okay, that's interesting. And then they sent me their portfolio. We analyzed the portfolio, and it turns out the portfolio was 38. So the risk that they actually had, and I assume that they were comfortable with over time because they had this portfolio for 15, 20 years, I assumed that 38 was the risk they really felt comfortable with. And I said, well, the questionnaire says you want quite a bit, almost twice as much risk as that. So do you really? And I'm not sure that they do, of course. So the point being that what the questions to answer are: how much risk do you want, which is the questionnaire; how much risk do you have, which is analyzing your portfolio; and how much risk do you need, which again does projections on a portfolio to achieve your objectives. Those are the three: how much risk do you want, how much risk do you have, and how much risk do you need. And those are the things that we answer for clients, and that's what I do. It's like, and that's and so it's even more specifically, given that people can say, oh yeah, I really do want higher risk than I have. Okay, all right. So let's just test that. Let's see what that means. So we do a projection over 6 months. Well, here with 95% probability, this is not certainty, this is probable. Okay, so within 95% of the time, the return will be plus this or minus this around your value. Okay, in 6 months. And is that something you can handle? Well, I don't know. That's a lot more risk than. Okay, well let's reduce the risk. And so, and that's over 6 months, because 6 months is a time period that most people can understand. Because they'll say, hey, wait a minute, I don't care about 6 months. I'm investing for 20 years. I'm investing for 10 years. Or I'm a young person, I'm investing for 50 years. Well, that's great if you could stay invested.
Yeah, right.
But staying invested means you've got to deal with what's happening over shorter periods of time. And so that's why we look at 6 month intervals. And anyway, it's...
Yeah, what you're saying to me here, and like we said at the beginning, it has this thing about a mindset, a mind shift, but I also say this is part about you being honest with yourself, because as you said, a lot of people, I would imagine, say, oh, my risk is 60%, 65, I can handle that. And they say, all right, let's go ahead and do that. And then they go, well, I don't know. So I tend to think that it's kind of that scenario where many, perhaps not all, would say, I caught a fish this big, but it was really that big. They're biting off more than they could chew, but when it comes right down to it, they can't do that, or they're not willing to take that risk, or their situation does not dictate for them to take that risk. So, how do you get people really to come out and put their money where their mouth is, so to speak?
Well, again, it's by doing this iterative analysis and these
Mm-hmm.
probability studies over 6 months, and so you can 95% probability. And that, by the way, what that means is that the other 5%, it could be way more than that, or it could be way less than that. Okay, and that's
Okay.
happened in the past. But given and so how do we do this? How do we do this calculation? Okay, we do the calculation based on what has happened in fact in the world, in the market, in the stock market, and with the securities that they may have or that they may want. Okay, and it looks at each security and the characteristics of each security. Now, what drives the price of a security? It's basically somebody's perception of its value in the moment, but also in the future. What is it worth? Okay, so the price of a security really reflects somebody's expectations, somebody's behavior. Okay, and what I do is, as I said earlier, is behavioral finance based, and to me, behavior tends to repeat itself. People don't know it fluctuates at the extreme between fear and greed, but it does tend to fluctuate within that spectrum of fear and greed. And you say, well, that sounds really good, Andrew, but so what? Well, no, here's the so what. The so what is that here's what's actually happened in the stock market or the financial markets, not just stocks, but bonds and stocks and other assets. Here's what's happened to this portfolio on average over these a 6 month interval. Here's what's with 92. It's two standard deviations for the people who know statistics. It's what's going to happen, 2/3 of the time, or more than 2/3, 95% of the time. One standard deviation is 2/3 of the time. Two standard deviations is 95% of the time. So what's going to happen? And that's what has happened in the past. That's probably going to happen in the future. And guess what? From a real standpoint, in my firm, working with real client money, and this is pretty institutional sized money. I mean, millions of dollars. It worked, and it was helpful, and it helped people. And the people I worked with, for what it's worth, were they were trustees. They were responsible for the money of the college or the school for which the endowment was intended, and so they had a responsibility to their constituents. So it wasn't like they were investing their own money. So they were especially mindful of risk and return. And I will say that in many cases there were financial professionals on these committees who were governing boards of the endowment funds. So they knew, they'd been to the rodeo before, they knew what was going on. But I will tell you right now that when they were tested, with bear markets in February of 2009, when the stock market hit pretty close to its bottom, it bottomed out in early March. But in February, I could tell you that meetings we had were, why do we own any stocks at all? And these were people who were professional investors, some of whom you would know from watching financial news networks. Okay, they were there, they were involved, and yet when it came to investing the college or the school's money, they were they put on their trustee hat and they were more careful. And so I said, well, here's the reason we do that. Well, because companies are incented to generate a return for shareholders over time. From time to time, the stock market will not value that prospect very highly, which is the case now. But historically, it has come back and has returned to its average, okay, which it did. And how would we do that? When you're down 50%, going back to average means you're going to go up 100, and it went up way more than 100. I already said it. In 20 years, it went up 634%. But so it happened. That's just what it happened. So, and there's no guarantee it's going to happen. Right? There's no guarantee.
Yeah.
It's like so many things in life. There's no guarantee. You just have to go forward with what you think is the best probability. So what I do to get at people's truth and being honest with themselves, and you put your finger exactly on the problem, people have to be honest with themselves, is to do these tests and say, okay, this is what you can expect over this period of time. And if people know what to expect, it's a little bit easier to tolerate the actual outcome, I think.
Yeah.
Although it's never comfortable losing money, but you're only going to lose it if you sell. Right?
Yeah, and I guess you can, kind of think about it this way too. At least I started to think about it like this: is putting the money in the bank to save it. I'm losing money anyhow over time. I'm not getting anything out of it.
Well,
Like I said, my dollar is not going to be worth a dollar 10 years from now. It'll be 83 cents or whatever it might be.
yeah,
So,
it's an opportunity cost. It's an opportunity cost, absolutely. Yeah, and I think people intuitively know that, but I think it's important to think about investing as, okay, we're kind of at the mercy of the big companies that sell us the stuff we buy every day. And they've been raising
yeah.
prices up until pretty recently because the rate of inflation is actually now quite low. It's back to sort of the average level, a couple of percent year over year. But so what do we do? Well, we can't. But why don't we have them work for us? If we invest with them, then we're going to benefit from their profits. And so look at it that way. And the other thing in terms of mindset, when I wrote the book, I just sat down and started writing from my history, from my experience. I just say, what's important to say? I just started writing. I didn't have a chapter outline or any of that stuff. I did have an editor who told me finally, hey, you got to have chapters. You got to make this logical, which I did ultimately. But I just said, well, no, I thought, I said, look, the working title of my book was Invest with Joy and Peace of Mind. And my editor, who was a financial book editor, said, no way you can use that. You cannot use that title. Nobody's going to, no, that's crazy. You can't use that title. I said, well, but that's what I think. You have to feel like somehow you have to feel good about this. You have to, because you've made a decision to save and not spend. Okay. That's not an easy decision to make for most people. Let's face it. People they want to live up to their earnings, and they don't. And saving is not the easiest thing to do, right?
Mm-hmm.
And the professionals call that a time preference decision. So you're making a time preference decision to I want to save some for the future. I'll spend some now. I'll spend some in the future, or you know what? I'm just going to spend it all now. And then in the future, there's nothing. Okay, if they stop making money, there's nothing. But if you do decide to save, you should say, hey, this is really good. I'm going to do it with joy and peace of mind. And I'm going to do it knowing that I'm assuming risk. The biggest risk I can take is by not assuming risk. Okay, because then you're not going to, for sure you're not going to keep it up after inflation. You're going to lose money to inflation if you don't. So to me, it's a mindset thing. It's being honest with yourself, but also feeling good about the decision to save.
Mm-hmm. I'll tell you what I started doing is I've been looking at it as I'm buying some time in my future when I'm doing my savings. And, some friends and people may ask, well, what do you mean you can't buy time? You can't get any extra time? And I tell them no. But the thing is, I am buying it because I'm investing it in my future, because when I get to that future point, I don't want to be working to keep on earning, to keep on having time. At least I've invested some, and I have a little bit of savings or whatever it is, an investment income. And then I have some free time where I could do what I want to do. And I don't have to work to get that, or never able to get it. That was my mental thinking
Well,
of
it's
certain
true.
things.
It's true, Chuck. You're buying freedom.
Mm-hmm. Yeah. Yeah, you really are. I want to ask you, Andrew, if you don't mind, reel it back a little bit, away from the endowments and things like that, for that small-time investor that's really getting into it. Do you have I don't know if recommendation would be the correct
Strategy?
word to
Okay.
use? Strategy,
All right.
thanks.
Let
Yeah,
me tell
as
you
far
this.
as
I can't. I mean, this is not. What can I say? It's not investment advice, but one of the things.
right.
There's a very famous investor whose name is Warren Buffett. I think most people know who he is. And
Mm-hmm.
he would say that people should probably put, if they're long-term investors, they should put the majority of their money into the Standard & Poor's 500 stock index, and a smaller amount of money in government bonds or short-term
Yeah.
government bonds. So there is risk in bonds. The risk in bonds is that when interest rates go up, the prices of bonds go down. Okay, and that means your return is lower. So if you have shorter term bonds, the prices don't fluctuate as much. If you have intermediate term bonds, which is to say a bond that might be 3 to 10 years, that's not going to fluctuate as much. And it may be that intermediate term bond. So you buy, say 80 or 90% in the S&P 500 and the balance in a short intermediate term government fund. And you can do this through ETFs. It costs very little. And
Yeah.
so I would say, and the other thing I would say that's super important to do is to do it don't invest everything in one chunk, but invest over time and dollar cost average, and do it on a very disciplined, programmed basis with your earnings. I mean, I think initially you probably want to put the majority of your money into an investment strategy, and know that it will be tested, it'll go down, but you have to stay resolute, and it'll come back probably. And at least it has. Now, there are no guarantees to anything. And by the way, people say, well, why don't I just buy an insurance policy that gives me a guarantee? Well, yeah, I guess you could do that, or an annuity. Well, yeah, I guess you could do that, but you have to understand, what the expenses of that are, and what the benefits are, and what happens if you want to change the arrangement. What are the expenses of changing it? They're quite high usually. So I wouldn't encourage anybody to go, do that. I would say to people, for just anybody, this is everybody, not just wealthy people, but everybody should think about, they should have a will. Okay. They should have a will. So they're passing their assets along to the people that they want to pass them along to, in the terms that they want to use. They might want to have a trust. Okay, which again it's not just for wealthy people. But average people could have a trust and hold the assets in a trust, including their house or their property. So there's a lot of benefit to doing, talking to an accountant, talking to a certified financial planner, and I'm not talking about people with lots of money. I'm talking about average people. They should do that. And yes, it's going to cost something. It will, you'll have to pay for some advice. If you have a good certified public accountant, that's another way to go, to ask them. And I would, most people trust their accountants about as much as they trust their doctors, which is good. You can, and you should. So you should do some planning. You should have a structure in place. So it's not just, having a personal account where you're investing, but no, it's like, well, how about your family, your kids, your, parents, your whatever. You have to think about that as well, because as time goes on, the assets will grow, and they'll be a lot more significant. And you should always think about, what's the most efficient way for me to invest? Is it to have a retirement plan, an individual retirement plan, or if you work for a company that has a 401k, are you participating in that as much as you should? So there are those questions to ask, and certified financial planners can help answer those questions. I don't really do that work. I'm more on the investment side, but it's important for people to think about those things. And initially, when you're young and starting out, it doesn't seem that important. But I guarantee you, in just a few years, it's going to get important, because you're going to get married,
like we were
or you're going to have
saying,
a partner, or yeah.
Where you're investing in time, and I'm wondering for the smaller investment person, the beginner. Well, maybe they're not a beginner, but you now have the ETFs; those have become popular. So is it? You hear some people say, "Oh, get ETFs and get dividends and reinvest in your dividends." Others say, "Well, I want to go for individual type of stocks, and I want growth more than dividends." Is there a percentage, 50, 20, 30 type of thing? Is there an age when you should go, I should start looking at more of a growth rather than a dividend type of stock?
Yeah, well, again, I think that what's interesting, in the studies that this firm that I work with on this application I've been talking about, is half the people over 70 are not conservative investors, and half the people under 30 are not aggressive investors. That's for starters. Everybody's different. Everybody is different. And, so it's hard to give like a blanket, do this or do that. I think that I tend to look at equity investing as a total return proposition, which is to say you get a return from the appreciation of the stock. You also get a return from the dividends that those stocks pay every quarter. Okay. And so now you can adjust that so you could have stocks that pay higher dividends, or ETFs, or individual securities that have higher dividend payouts. But understand, if they're doing that, they're not reinvesting in their own company. And so that the companies that tend to grow the fastest have the lower dividends because they're reinvesting in their company. Some companies had no. I mean, there were some major companies that we know about that had for years and years and years no dividends at all. And now they have some dividend. And dividends are important for sure to returns. But to answer your question directly, it's very difficult to do that because I get back to what is the person's desired outcome? What do they want to do? How much do they want to earn? And then, once again, if you think about it like this, that, okay, over time, we might expect the stock market to do 10%. Now, having said that, there's a major firm, Goldman Sachs, that came out a week ago and said for the next 10 years, the stock market is only going to return 3% a year. Okay, not the average that it's returned over 100 years, 10, but it'll return, or for that matter, what it's done, in the last 10 years, which has been about 11% a year for the last 10 years. But it's going to be 3% a year. Well, okay, maybe it'll be 3% a year. So, and that, by the way, if it's only 3, then you really want to control your expenses because investment expenses are going to get to be a big percentage of that return if it's only 3. So, but you have to. But if you want to. So I can't say that, let me put it this way. Most retirement planning comes up with a return that's around 6 or 7%. Mm-hmm. And that's the target return that many people make for retirement planning for longer term plans. And I'm talking about people that have more than 10 years to go to retirement. Okay, it could be 50 years, could be 20, but it tends to be 6 or 7%. Now again, 7% doubles money in 10 years. A portfolio that would have been invested about 60% in stocks and about 40% in bonds would have done something around 7% a year over time, maybe a little less, maybe 6.5. So that's, I don't know if that answers your question. But now, what I would say, the other thing, a cautionary note I would give to people is that sometimes people get focused on, well, I can get a lot of income if I invest in this particular stock that pays a high dividend. Okay, I would just say, understand that chasing yield, which is what that would be called, you're chasing the highest yield, is not necessarily the right thing to do because this happened back in, I don't know, a dozen years ago with master limited partnerships that basically own pipelines and things, and they were paying out 90% of the earnings as dividends. So people were attracted to, in a low interest rate environment. Remember I said earlier, interest rates were, and we all know they were like 1 or 2% maybe, and these were paying like 6, 7, 8% returns. Oh yeah, let me do that. And that was great, and that worked, and the prices of those securities went up, which is even better because they were paying big dividends and the prices were up. And then interest rates started to go up, and the prices of those stocks went down a lot. So chasing dividends it's very much a two-edged sword, and I don't encourage people to do that. What you want to see in a stock portfolio is a stock portfolio that over time the dividend payout or yield at your cost goes up, which means that the dividends of the stock portfolio that you own grow relatively quickly, okay, and that what that means is that if you start out with a dividend that might be 1 or 2%, but if those dividends grow at your cost, at some point those dividends could be 3 or 4 or 5% or more. Okay, so it's dividend growth that is important to me, not the current rate of a dividend yield. And I know that is counterintuitive because people are, I want that money right now. I want to get income every 3 months from this stock. And okay, fine. But just understand that you're doing so at the expense of growth of the principal, relatively speaking.
I guess this really comes back to, like you said, the 3 questions you need to ask yourself. How much risk are you willing to take? How much risk do you have in your portfolio? And how much risk do you need to achieve your goals?
Yeah, that's it, Chuck. I mean, it's and this sounds like maybe it sounds too complicated for a lot of folks. And it when you sit down, it's like, how do I get my head around this? I don't know what do you mean risk? What are you talking about, Parrillo? What are those? And all I'm saying is that if you think about the Standard & Poor's 500, again, a 10% long-term average return, but it's fluctuated like 2/3 of the time between plus 30 and minus 10. Not quite, those numbers are round numbers, but that's close enough. So that 2/3 of the time it could be up more than 20 or 30, 25%, it could be up 30%, or it could be down 10%. And so you have to calibrate your thinking to to that. And again, I talk about this pretty in a detailed way in the book, where I talk about exactly what I'm saying now. If you want to allocate your own assets, you can do that. Now, an easier way to do that is to say, well, look, most people would have a portfolio that's about half in stocks, or maybe 60% in stocks and 40% in high quality bonds. And that's a perfectly prudent, solid portfolio. Okay? It's not necessarily, and I don't know what the yield on it will depend on the yield in the stock market and the yield and also yields on bonds, of course. But that's a reasonable. So that would be if you want a kind of a simple answer, it's well, just invest 60-40 or 70-30 and be patient.
That's good. And I was going to add in if somebody's having a difficult time trying to figure out, how much risk do they want and how much do they have in their portfolio and things like that. I say, look at it this way. How many movies do you want to go to in a month? And you say, I want to go once a week. All right, that movie's $20 a pop. And it's like, well, how much do you have in your portfolio? How much, extra spending money do you have? Well, I've got like $100. And how much are you willing to spend to go see, those 4 movies? And you go, well, I have enough. And then I say, do you want any popcorn? Well, yeah. Okay, you can only get popcorn at one of the movies and a soda because now you've reached $100. So do you want popcorn and soda at every movie? You can only go to 2.
Yeah. Well, again, you get back to some simple thing. If people go to a compound interest calculator on a search engine, Google or whichever one you want, and just put some numbers in. Just run some numbers. Say, okay, let me see. I'm going to put, instead of going to the movies, I'm just going to watch Netflix, okay, which costs whatever, $20 a month now, I think. Something like that. And I can watch a lot of movies that way, and I won't have to buy a lot. I don't have to pay a lot for popcorn or anything else. Right. And then I'm going to save the other 80. That I would spend if I went to a movie a couple times a month. So again, we get back to what's the sensible financial decision to make. It's not always necessarily going to be the most fun or the most immediately gratifying, but I guarantee you, over time, it's going to be very gratifying.
Yeah, you don't want to be that person that when you get to your 50s, maybe your 60s, and you're excited for retirement in 10 years, 7 years, 17, whatever it might be, and you start counting and you go, well, let's see, I have a mortgage right now, and that won't be paid off till I'm like 70 years old, and my retirement, I got like 40,000 in the bank. And then you talk to somebody else and they say, oh, I've got $1.2 million in the bank right now. And you say, well, how did you do that? Well, I started saving $200 a month when I was 25 years old. And then it's like, well, that doesn't add up. Well, yeah, compounded interest. It adds up. Those aren't exact figures.
That's what I'm saying. It's like, it's like what I do is boring. All right, what I really do is super boring. It's not exciting. It's not supposed. In fact, it's the opposite of exciting. Okay, and yes, the stock market will be exciting at times when it goes down, and you'll be terrified. You'll be terrified because oh my God, my money just went down 30%, 40%, and you'll be terrified. But you have to sit, hang in, and it'll come back and stay on the program. Stay on track. So it's like. But with the exception of those intervals, which do happen, okay, it's pretty boring. It's not going to be done. One of the things I talk about recently is back in August, early August, there was a weekend where the Japanese central bank raised interest rates by 0.25%. And it caused a major disruption in this, what was called a carry trade. It's a very sophisticated kind of arcane financial device that professional traders use to arbitrage buying something that had, at a low interest rate and investing it in something that had a higher interest rate. And also doing that by borrowing a lot of money, leveraging it. Okay, so increasing the value of what you had from 10 to 100 or 1,000 or something. And if you could borrow at 0 and invest at 1, then you were making 1%, right? But what happened when the carry trade, putting aside all of the craziness about currency conversions and so forth. It really freaked people out over that weekend. Okay, at the same time, I think it was on a Thursday, there was an unemployment report that came out, and the U.S. unemployment was 4.3%. So, and it had been running pretty much below 4% for a while, and people really got concerned, and the market sold off for a few days. And I was like, wait a minute, why are people? First of all, the unemployment rate average for the last 50 years was like 6.2%. Okay, and here we were at 4.3, and people were totally upset and freaking out. It's like, wait a minute. Now, maybe it's going to go up a lot, okay, but this is not that bad, okay? And it turns out, by the way, a month later, the unemployment rate went down to 4.2, okay? Now, we don't know where it's going to go, but, it's like, so my point of this story is that weekend, or that 5 or 6, 7 days, the market was declining, and people were all concerned about the carry trade was no longer working, and unemployment rate was up, and that meant that we're going to go into a recession because that's always happened in the past. And guess what? Didn't happen. The market came back, and unemployment went down again. I mean, so and even if it had gone the other way, and unemployment continued to get worse, and there was more disruption in these arcane financial machinations, I still maintain that that's not enough reason to change your long-term strategy because of something that's happened in the last week. Okay? I mean, no. I mean, basically I'm saying that try to avoid thinking about Nirvana or Armageddon. We're probably not going to have Nirvana. We're probably not going to have Armageddon. It's going to be something in between, and a lot more things can happen than will happen, and that's what you have to keep reminding people of that. And it's not easy to do, and that's anyway.
It's not, and I want to say these have all been really great talking points.
Yeah. Well, again, this is not investment advice; it's investment perspective. It's not specific advice for anybody because, again, every investor has to have make their own determination of their own risk and return preferences, and they should seek, the right sort of tax and legal advice, and they should probably seek, they should do enough research into the investment vehicles that they're considering to understand, what the nature of that vehicle is, what's likely to happen, what's happened in the past. Okay, let me put it that way. We don't know what's going to happen in the future. Nobody does, and anybody that tells you they do should be suspect. Okay, so. Anyway, that's a good sort of warning, I guess, is that this is for perspective for people, but it's super important to examine it and to not just push it aside and say, as many people do, I'm intimidated by investing. I can't do that. I have to have somebody else do it for me. And the reality is, even if you do go to an advisor of any sort, whether it's a robo-advisor or whatever, an actual person or what have you, it's you are your own chief investment officer. You always are. So you have to make the decision, and guess what? You are going to make the best decisions for you.
Well, Andrew Parrillo, I want to say thank you, and once again, folks can go to victoryroad.com.
Yes, sir. Yeah, check it out. I mean, there's a lot of information there, and I'd be happy to talk to anybody that wants to, engage. That'd be great. And I'm most appreciative of you, Chuck, because this has been a lot of fun.
Well, no regrets today. And for those of you watching and listening, I'm sure you had no regrets spending the time this afternoon or morning and evening, whenever it was, with Andrew Parrillo. So thank you very much.
It's my pleasure.